What's going on? Welcome back. In this video, we're talking about calls and puts. Okay, so I have another little slideshow that I'm going to use, and let's talk about calls first. Now, again, remember, options are contracts, right, between buyers and sellers. And when you buy an option, you have the right, but not the obligation, to purchase or sell the underlying asset at a certain price before or on a certain date. Okay. Now, a call is a type of option. Okay. And let's talk about buying calls first. So, buying calls, right? Purchasing a call option gives the holder the right, but not the obligation, to buy the underlying asset at a certain price before or on the day of expiration. Okay, so when you're buying a call, you are buying that right, but not the obligation to buy the underlying asset, right? Calls are for buying. Okay, so let's talk about a quick example, right? So, for example, if you purchased a call option to buy Apple stock at $300 and Apple was trading at $280 at the time of expiration, you wouldn't exercise that right? Because why would you buy Apple at $300 if Apple's only worth $280? It doesn't make any sense, right? On the other hand, if Apple was trading at $320, you could then buy Apple at the $300 price, which is what your option is for, and you could immediately capture $20 of profit per share on Apple. Okay, so let's go through this one more time. Purchasing a call option gives the holder the right, but not the obligation, to buy the underlying asset at a certain price before or on the date of expiration. So again, for example, if you purchased a call option on Apple, right, to buy Apple stock at $300 and Apple was trading at $280, you wouldn't exercise your right because Apple is trading at $280 and you have the right to buy it at $300, right? So you're not going to buy something for $300 when it's worth only $280. Okay. On the other hand, though, if Apple was trading at $320, you could then buy Apple at $300 because that option gives you the right to do that, and you could immediately capture $20 of profit per share. Okay? So, moving on, let's talk about the other side of this trade, right? So, if you were selling a call, if you're selling calls, right? Selling a call obligates the seller to sell the underlying asset at a certain price on or before the expiration date, right? So remember, there's two parties when it comes to the options, right? There's the buyer and then there's the seller, right? So we just looked at buying calls, right? So when you buy the call, you have the right, but not the obligation to buy that asset. And on the other side of that trade is the person selling the call. And the person who sells that call is obligated to sell those shares to the option holder, who is the buyer. So again, selling a call option obligates the seller to sell the underlying asset at a certain price on or before the expiration date. Now we're going to use the same example and let's run through that real quick. Okay, so for example, if a buyer purchases a call option to buy Apple stock at $300 and Apple was trading at $280, the buyer would not exercise that right. On the other hand, if Apple was trading at $320, the buyer would exercise his right to buy at $300, and the seller would be obligated to sell those shares to the buyer at $300, right? So remember, in the buying call example, if if Apple's trading at 320 and you own that call option to buy at 300, you immediately capture $20 of profit per share. And then on the other side of that, the seller of that option would be the person selling you those shares, and then they would immediately lose $20 per share because they need to deliver those shares to you, right? So important to understand that for every option contract traded, there is a buyer and a seller on either side of the trade. And I highly recommend that you conceptually understand this, right? Make sure you understand the definitions, right? That the buyers of options have the right but not the obligation, and that the seller of option is obligated to deliver, right? Which is to either buy or sell the other side of that trade. So let's talk about puts, right? So the two options are the calls and the puts, right? And the calls, when you purchase a call, you have the right to buy. But when you purchase a put, you have the right to sell. Okay? So when we're buying puts, purchasing a put option gives the holder the right, but not the obligation, to sell the underlying asset at a certain price before or on the date of expiration. So for example, if you purchased a put option to sell Apple stock at $300 and Apple was trading at $320, you wouldn't exercise that right? You wouldn't sell something at $300 when you could sell it at $320, right? It doesn't make any sense, right? On the other hand, though, if Apple was trading at $280, you could then sell Apple at $300 and buy those shares back at $280, and you could immediately capture $20 of profit, right? Because think about it. If Apple's trading at $320, but you can sell at $300, there's no point at selling at $300 because Apple is worth $320, right? You would rather sell at $320 than $300. Again, if Apple, though, was trading at $280, well, you could sell at $300 and then buy it back at $280 and capture that $20 of profit. I find that this conceptually confuses people, right? Because remember, you can make money in the stock market and with options by buying low and selling high. But on the other side of that, you can also sell high and buy back low to produce a profit. Okay, so I know that these definitions and understanding that there's buyers and sellers and that you have calls and puts, right? It's really important to understand these definitions because this is where people can get confused. This is where if you don't understand this and then you start trading real money, you can get into trouble with this if you don't quite understand conceptually and from a definition point of view, like what exactly this means. So I highly recommend that you go over these examples and continually think about this until it's so ingrained in you that you just know it and understand it, okay? So moving on, let's talk about selling puts, right? So we talked about buying calls, we've talked about selling calls, we've talked about buying puts, and now let's talk about selling puts, right? So selling a put option obligates the seller to buy the underlying asset at a certain price on or before the expiration date. So remember, when you bought the puts, right, if you're buying the puts, you're saying, I'm buying the right to sell. And on the other side of that trade is someone taking the obligation to buy from you what you're selling. Okay? So using the same semantics of this example here, if a buyer purchases that put option to sell Apple stock at 300 and Apple was trading at 320, the buyer would not exercise that right. Remember, we're not going to sell something at 300 when we could sell it at 320. It doesn't make any sense, right? On the other hand, though, if Apple's trading at 280, the buyer of the put option would exercise his right to sell at 300. And the seller, right, if you sold that put at $300 and Apple was trading at 280, you as the seller have already obligated to buy those shares at 300, and you would immediately incur a $20 per share loss, right? Because Apple's at 280 and you have bought shares at 300 because you sold that put option and you were obligated to buy the shares at 300, and you're buying from the person who's selling, right? Because the person who bought the put option, he bought the right to sell at that price, and you've obligated to purchase that from him. Okay, this is extremely important. I would say that the original definition of options right, which is, understanding that buyers of options are buying rights but not obligations, and on the other side of that, the seller is obligating himself to do something. And that applies to the calls and the puts, right? So the calls are for purchasing if you're a buyer, and the puts are for selling if you're a buyer. And then on either side of that trade, it's the opposite. So this can be very confusing for beginners, or if you don't have a lot of experience in this. Of course, I'm always here to answer more questions and try to help as much as I can. A lot of the time I find that one-on-one coaching, working one-on-one with someone when they're struggling and actually going through a real trade in the live market can really help solidify the understanding of these concepts. But again, this is really, really important, right? Understanding, the definitions of these and then how they apply to calls and puts. So I want to go over this one more time in this video, just real quick to really solidify, because I know it's a lot of information conceptually. It's you kind of got to think about it. So let's go through this one more time. Okay. So purchasing a call option gives the holder the right but not the obligation to buy the underlying asset at a certain price before or on the day of expiration. So for example, if you purchase a call option to buy Apple at 300 and Apple was trading at 280, you wouldn't exercise that right. And on the other hand, if Apple was trading at 320, you could then buy Apple for 300 and you could immediately capture $20 of profit. Okay. On the other side of that, exact same trade, right? If you're selling a call option, you're obligating yourself. Selling the call option obligates the seller to sell the underlying asset at a certain price on or before the expiration date. So for example, if the buyer purchases that call option to buy Apple at 300 and Apple was trading at 280, the buyer's not going to exercise that right. And on the other hand, if Apple's trading at 320, the buyer would exercise his right, and the seller would be obligated to sell those shares at 300 and would take a loss. Okay? So again, really important to understand, there are calls and there are puts, and you can buy or sell either of them. Okay? So again, with the puts, purchasing the put, right? If we buy the put, you're basically buying the right to sell the underlying asset at a certain price before or on the expiration day. Okay. So for example, if you purchased a put to sell Apple at 300 and Apple was trading at 320, you would not exercise that right. And on the other hand, if Apple was trading at 280, you could then sell Apple at 300 and buy those shares back at 280, and you would immediately profit $20. And again, on the other side of this trade, there is somebody selling that put, right? So when you sell the put option, you're obligating yourself to buy the underlying asset at a certain price before a certain date. And the same example, right? If the purchaser purchased a put option to sell Apple at 300 and Apple was trading at 320, the buyer is not going to exercise, right? And on the other hand, if Apple's trading at 280, again, the buyer's going to exercise his right. He's going to sell at 300. And the seller is obligated to buy those shares from the option holder. And if Apple's trading at 280, the seller of this put option is going to incur a $20 loss, while the person who bought the put option and is selling at 300 is going to incur a $20 win per share. Okay, so I know that this is a little complicated. This is probably the most difficult thing to conceptually understand at first, but then once you start doing it and you start seeing how it works, it becomes easier and easier. And believe me, this is where the real power of options lie, right? Is in understanding these definitions, understanding what it means to buy, understanding what it means to sell, and how that applies to calls and puts. And we're going to continue to look at this in more detail with examples as we dig deeper and we add more definitions and more things that we need to understand and look at when we're actually starting to trade. Okay, so I hope this has given you insight. Again, please reach out if you have any questions. I also offer, one-on-one coaching if you really need help at an accelerated rate. Nothing is better to really accelerate your learning than one-on-one coaching time. Okay, so reach out to me, ask questions, leave comments, and I look forward to speaking in this next video.